Welcome back. We have been discussing with the external members of the MPC, Dr. Shashanka Bhide, Dr. Jayanth Varma and Ashima Goyal. The key takeaways from the minutes as well, we would like their views on the state of the economy. Dr. Goyal, Varma and Bhide, thank you very much for your patience. Ashima, I wanted to ask you about this reference you make that if you find unusual activity in certain areas, maybe the RBI should use higher risk weights on those categories, but not tinker with rates. Do you think that is called for in the context of the rise in unsecured debt?
Macroprudential regulation is an alternative tool, and so that you can keep your interest rate tailored to the needs of your domestic cycle. And also, and therefore, that the RBI has to see, they have all that data. And I think that the real exchange interest rate did not really rise until the end of December last year. And that is where we see that the quarterly savings rate is actually, financial savings is rising once more. We are seeing households coming back to bank deposits. So we need to watch and see before we decide whether we need to use macroprudential tools. But it is better to target the interest rate to domestic inflation and growth and macroprudential tools to any financial kind of excesses. It's not, household debt is very low in India and it has to rise as we develop, but any sharp rise can create risks. Therefore, there is a scope for counter-cyclical tightening. And I just wanted to make a brief comment on that liquidity question. You know that as soon as you're in an inflation targeting regime, liquidity becomes endogenous. So it's just a question of whether liquidity will stay at the upper bound or the lower bound of the LAF corridor. And if liquidity is kept tight, so you're more at the upper corridor, but currently a lot of banks have surplus liquidity and they are parking in the bottom.
The SDF, yeah.
So and it is a question of the whole apparatus getting refined so that interest rates do not vary as much, and there is success in that. But further developments need to take place, and it's happening as markets deepen. Yep. Banks have to start lending and borrowing from each other.
Yes, I agree. It's actually the NEFT and the RTGS that's clearly made everyone a little nervous. They want to keep some excess cash because you could have large transactions all the way up to 5:30 and 6, whereas the call market closes at 3:30. So perhaps some tinkering of timings is needed. But very quickly, Ashima, in your estimate, when can the Reserve Bank even start, when can the MPC contemplate rate cuts?
This is an issue when we are convinced if your real rate is around 1 and inflation falls, right? And with the repo of 6.5, you would get a real interest rate that's really rising, right? So we when our forward, and it is forward looking, the MPC's decision. Okay. So when we are convinced that 1 year ahead inflation is approaching 4, then our real rate would become too high. That's so right. We would need to cut.
Okay. So we have to watch out for the forecasts.
Since we have these recurrent supply shocks, we want to be a little more cautious and wait to see this happening in a sustained way.
Fair point. Dr. Varma, would you worry that, this is not really a monetary policy question as much as an economist's question to you. Would you worry that there can be a big financial downturn in the US? After all, across the curve, interest rates have risen by about 135 basis points in the last 3-4 months. Are there makings of a deep downturn suddenly and sometime, in 24?
Well, I think this is a worry that everybody has. A very sharp correction in inflation via monetary policy always runs the risk of a hard landing. And it is the endeavor of rate setters across the world to avoid that hard landing and try to bring inflation down with a soft landing. But since this is all forward-looking and there are so many uncertainties, that risk is always there. And I think rate setters are very, very conscious of that risk, and they're acting in light of that risk.
Okay. Finally, a similar question like I asked Ashima and Dr. Varma. Dr. Bhide, can you sense when we can even contemplate lowering rates? Has it gotten pushed, into the second half of calendar 24?
Well, I think obviously one would like to have the interest rates lower with inflation lower as well. So I think it's difficult to put a timeline to this. As we said at the beginning, the forecasts are important, projections are important. So I think getting back to under 5% is one, obviously, one criteria. But I guess it is also important that growth is sustained. So I guess I would not put a timeline to this. I mean, it's important that we see the inflation rates going down in a sort of sustained manner.
Fair point. Thank you. I'm out of time, not out of questions. Dr. Bhide, Dr. Varma and Dr. Goyal, thank you very much for sharing your views, not just on the MPC, but also on the state of the economy. Actually, after listening to you, there doesn't seem to be that much of a variation between the various MPC members, whether they're external or whether they're from the Reserve Bank. Clearly, the concerted view of everyone is that we have to see visible signs of a sustained dip in inflation towards 4%. So at the moment, discussing the first rate cut seems really pushed out. With that, we wrap up on this special edition on the Monetary Policy Minutes. Thank you very much for watching. More news and updates are lined up for you.